I did exactly the same things I did on Monday, and the slides now work. Actually, on Monday, the second class I taught, the slides work. Just something weird in that
file, maybe.
But the same file. I opened it today. It's okay. So it was. I mean, I could say it's PowerPoint, but why did PowerPoint not work at 10:30 and the same PowerPoint worked at 1:30? Kind of an idiosyncratic, some combination. Who knows?
You like shut off your computer and turn it back on, or
the problem is I can't do that with the desktop. That's not my computer. It's just you know, my computer. I had more control over it, but the desktop, you turn it off. God only knows whether it'll even come back on. So you know, I can't risk anything that will kind of pour sand into the machine.
I don't know if you remember the Game Boy, like back in the day, where you almost like.
Well, you know what?
Like,
what's the fix that most frequently works when your technology is not working? What's the one fix that seems to work best? Turn it off and turn it on again. I mean, it's weird, right? You think it's some software glitch, but turning it off and turning it on again seems to be so. But the problem here is you turn it off, everything goes off. It'll take 10 minutes for it to kind of
integrated, right?
because it's an old desktop. So you turn it off, God only knows what will happen as it turns back on. It takes forever, and then it tries to fix itself. Okay, folks, I'm going to ask a question I haven't asked since the second week. Has everybody picked a company to analyze? If you haven't, you're probably too embarrassed to admit it, right? Because there are still some names with no companies next to them in the master spreadsheet. I just assume it's kind of slipped your mind. So when you get a chance, could you please go in and enter the company you're analyzing into the master spreadsheet? Because I at least like to see what you guys are looking at as I teach these classes. So last session, I made up a lot of crap in terms of numbers because I didn't have the slides behind me, right? So let me go back and fix some of the crap I made up. Let's review. Disney right now is about 12% debt or $16 billion in debt. That's where it's right now. Based on our assessment of what will happen to its cost of capital, if it goes to a 40% debt ratio, we believe we can lower that cost of capital to 7.16%. Remember, when I come up with that 7.16%, it's not built on the presumption of fooling anybody. I'm paying the new debt holders a fair market interest rate. In fact, I'm being more than fair because I'm taking the old debt holders, the 16 billion, and giving them a higher interest rate to be fair, right? So I'm not pulling off a Nabisco on them. A Nabisco would be to leave them at their old rate while I go and borrow more money. So think of this as a fair solution. I'm paying the lenders what's due. And by doing it, I'm lowering the cost of capital. So let me review that last page because I want to use the real numbers here to back it up. The existing enterprise value for Disney is 133 billion. That's basically the market cap of equity plus debt minus cash. That's the existing value of the company. I'm suggesting that Disney go to a 40% debt ratio. Let's see the impact on value. Right now, the cost of funding that entire enterprise value is the existing cost of capital, 7.81%. That's a cost of 10,458 million. And I wanted to be clear that that cost is not an explicit cost. You're not actually paying our 10.458 billion because a lot of it is equity, cost of equity. If I go to my new cost of capital, that cost will drop to 9,592 million. In effect, I'm saving $866 million by doing this next year. Keyword is next year. The company can be expected to grow over time, and as it grows, the savings should grow as well. So the present value of saving 866 million, if I can grow the company at the risk-free rate, which is basically the growth of the economy, translates to 19.6 billion. That is how much Disney will gain by going to its optimum. But I also was very cynical about where that increase in value is coming from. It's not coming from taking better projects. It's not from taking different projects. It's from taking advantage of the tax benefit of borrowing money. In effect, tomorrow, if the US either went to a 0% corporate tax rate, which is never going to happen, or if it said interest expenses are not tax deductible anymore, which could happen, that 19.6 billion would kind of disappear. So let's be very clear, increases in value from leverage are not increases in value coming from operations, they're increases in value coming from taking advantage of the tax code. That's not meant as something, I'm not saying it's unethical or immoral. It is the tax code. You are the board of directors. It's your fiduciary responsibility to do what's right for your shareholders. So if you go to 40%, I'm not going to point fingers at you and call you immoral for doing it. You didn't write the damn tax code. So if some congressman or senator wants to get up and accuse you of being immoral for borrowing money, ask them who wrote the tax code. You guys wrote the tax code. You put in the tax benefit. So either give the same tax benefit to equity or remove it from debt, but don't accuse people who are essentially using the model that you've created to go out and borrow money. So let's say you're in front of the board of directors of Disney. Remember the question that triggered this entire calculation. Why should we do it? And you tried the 7.81 to 7.16% drop in the cost of capital, and they weren't impressed. They said, no, you want us to go and borrow $39 billion and buy back stock because our cost of capital is going to go down by 0.65%. You've converted that 0.65% to real money. So let's say the board's interested. They say, okay, that sounds interesting. So you want us to buy back stock with $39 billion. Now comes a practical question. When you go back to buy, first, if you're going to buy back $39 billion worth of stock, do you know what you need to do? You can't go to the market every day and buy a little bit because that'll be viewed as price manipulation. You have to make a tender offer for your own shares. It's like doing an acquisition, but instead of acquiring another company, you're buying shares in your own company. So let's say you decide to do that tender offer for your shares. You put out the old days, a full page ad in the Wall Street Journal. If you're a Disney shareholder, we will buy back your shares at X dollars per share. At the time that I did this analysis, Disney's stock price was $67.71. I could try to buy the shares back at $67.71, but nobody's going to sell it back because they can sell it in the marketplace. I have to offer a premium. So let's say I'm your advisor. I've convinced you to buy back shares. And you say, well, how much of a premium should we be willing to offer? I'll give you the fairest answer. And here's what I mean by fairest. Remember, think of yourselves as all of the shareholders in Disney. Some of you are going to sell your shares back to me. Some of you are going to stay in the company. You know what the fairest solution would be? If all of you got the same share of the spoils. In other words, if I take the 19.6 billion and I looked across all of the shareholders, I want both people selling their shares back and the people remaining to get the same shares. I'm going to call that my rational solution. In a minute, I'll explain what I mean by rational. I want to make you indifferent between selling your shares back to me and staying as shareholders. It actually makes my life very easy if I take that path, because I can take the $19.6 billion increase in value and divide by the total number of shares outstanding, even though I'm going to buy back some of the shares. That increase in value is $10.90, and that added on to the $67.71 gives me a price per share of $78.61. If I pay $78.61 on a buyback, the people who sell their shares back will get $10.90 more per share, and the people who stay in the company are also going to get $10.90 back. That's a fairest solution, and it almost never gets delivered. Think about the process. It's a tender offer, right? So who do I employ to get this tender offer kind of in practice? As a company, I don't have the logistical wherewithal to do it. So I hire an investment banker, right? And I give the investment banker a mission. Go and buy back shares because we've got this this $39 billion of debt we've taken on. Go buy back the shares. As an investment banker, you now set the price at which you buy the shares back. You want to make your life easier. So if you want to make your life easier, because your mission is delivered as soon as you buy back the shares, are you going to try to set the price at a higher number or a lower number? If you set it at a lower number, nobody would sell it back to you, right? So you want to go high because it makes your job easier. When companies buy back shares, they often overpay. They pay $80, $81, $82 because the people that you've employed to carry out this deal are not thinking of the remaining shareholders. Their incentives, let's get this done, let's get this done quickly. In other words, a buyback price for in a rational world would be $78.61, but you might end up paying $82, $83, or $84 per share. If that happens, think of who wins and who loses among the Disney shareholders. If I pay $84 per share, who walks away the winners in this transaction? The people who sell out their shares. And guess who I punish? My loyal remaining shareholders. So if you're going to make a mistake as a company, would you rather reward the people who sell their shares and walk away or reward the people who stay in the company? I'd rather have the people who stay in the company, which means I want to find a way. This becomes my reservation price then. I want to be able to sell the shares back at less than $78.61. Remember, I'm still paying more than $67.71. I'd love to be able to buy the shares back at 75 or 74, or maybe even 67.71. So I'm going to give you the more general way of thinking of what happens to the remaining shareholders depending on what you pay as the buyback price. Take the increase in debt, in this case, the $39 billion. Tell me the price at which you're going to buy your shares back. Let's say it's $75. I'm going to compute how many shares you buy back. I'm going to net those shares out from the 1.8 million shares or the 1,800 million shares. I'm going to net them out because after the buyback, that's what's going to be outstanding. Then I'm going to take the value of the firm that I computed after the change. Remember, I computed the value of the firm would increase by 19.6 billion. I'm going to take the new firm value with that increase built in. I'm going to subtract out the new debt that I'm going to have. Remember, I'm borrowing 39 billion, and I'm going to come up with a new value of equity. And I'm going to divide that new value of equity by the remaining shares outstanding. And here's what I'm going to find. If you paid less than 78, whatever the break even was, 78.61, the remaining shareholders will end up with a price higher than 78.61 because you reallocated the 19.6 billion disproportionately to them. If I pay more than 78.61, the remaining shareholders will actually end up with shares worth less than 78.61. There's only a certain amount of pie to pass around here, 19.6 billion. And if I give a disproportionate amount to one group, the other group always has to pay a price. So let's try this with two prices. If you're the existing shareholders, what's your best possible price? What's your dream scenario in the buyback?
The current trading price.
That you find a sucker who's willing to sell the shares back at the existing stock price, right? Let's say you find that sucker, and you might get lucky. Remember the Bass brothers? There used to be these wealthy people from Texas. They used to own a big chunk of Disney, but then they made some bad bets in the commodity markets and they needed cash. Let's say that you have a big shareholder like the Bass brothers who needs a lot of cash and you're going to do a buyback and they say, look, we want to cash out. And normally when you cash out, you actually cause the price to drop. And here I'm offering you a chance to sell your shares back at 67.71. You'd have to be a really big shareholder because it's $39 billion. But let's say you find that shareholder. You're able to buy the shares back at 67.71. Remember, you had 1,800 million shares outstanding. Once you bought the shares back, you're going to have 1,221.43 million shares, far fewer shares. Let's now compute what the new value of equity will be if you carry this up. Your increase in value with the 19.6 billion added is going to be 153. But remember, it used to be 133.9 billion. With the 19.6 added, it now becomes, so you have a bigger firm in terms of value. You have far more debt than you used to. In this case, 55,136 million, because you added the 39 billion. You're saying, what's the 3,931? That's a cash balance. That's not changing in this transaction. My new equity value will be 102 billion. That's actually lower than my equity value before I did the buyback, you're saying. So why would I do it? Because you have far fewer shares outstanding. If I divide the new equity value by the shares outstanding, the value that I get for the remaining shares is $83.78. Remember, the fair price was $78.61. By buying the shares back at $67.71, I've effectively transferred wealth from the people who sold their shares back to who's left. Yes.
So in effect, the new market value for the shares would be 83.78.
Exactly.
Not
Exactly.
67.
It won't be 70. So in a sense, what happens to share prices after buybacks is determined by one variable and one variable alone, which is the buyback price higher than the fair price or lower than the fair price? In this case, because I paid less than the fair price, I'm transferring wealth to the remaining shareholders of the company. If you want to get comfortable with this exercise, here's what I want you to try. Try a $72 price. Try a $75 price. Try an $85 price. Work through prices, see what the effect is. But remember I told you the $78.61 was a fair price? Let's see if that's true. If I pay exactly $78.61, my share count becomes 1,301.65. It's higher than it was with $67.71 because of the higher price, I end up buying fewer shares. If I work through the firm value is still the same because the increased value is the same. And I subtract out the debt. I take the 102, I divide by 1,301.65, magic. I get exactly the same value. So if you ever have doubts about how do I know that this is the rational price, actually work it through. And if it's a rational price, guess what you're going to find? The people who sold their shares back and the people who remain end up with exactly the same price. Now, do you see why, as a company, you shouldn't hand this over to bankers? Because their incentives are very different. They want to get the deal done. And it's easier to get the deal done by pushing up the buyback price because it lubricates the sale. But in the process, you're ending up hurting the remaining shareholders in the company by transferring wealth because you're paying too high a price. Any questions on buyback prices? Yes.
Just sort of like extending that argument, like if it's our best interest as a company not to contract with the bankers, but they're the same ones who have the means of executing it, right? Isn't that sort of like an oxymoron?
The question is, if they're the only game in town,
right,
you're going to do it, right? So maybe your incentives should be, can you compute that break-even price on your own? Is there any rocket science involved here? So if you're the company, I think due diligence requires that you compute the price and you give the assignment to the bank. You say, do the buyback with the condition. What's the condition? As long as you can do it for a price less than 7. I'm not asking them to do something unrealistic like sell at today's price. I'm just putting a cap on the buyback price. Companies can't abscond from this responsibility, which is what they've tended to do, right? Goldman Sachs told me to do it, so I did. What kind of an answer is that? This is, again, hiding behind this opacity of this is complicated, we can't do it. The banker knows nothing more. In fact, you know more about your company than the banker does. And you should be able to set that reservation price. In fact, at Berkshire Hathaway, Warren Buffett, when he introduced buybacks, because Berkshire Hathaway did not do buybacks until about 20 years ago, 15 years ago. When he started doing buybacks, he introduced a condition. It was actually much more stringent than this one. You know what the condition was? Anybody know the Berkshire Hathaway condition for buying back shares?
So the way that he calculates book value.
He had an intrinsic value for the company, and he said, don't buy back shares if the price you're paying is higher than the intrinsic value. There's a little bit of fuzziness on the intrinsic value, but that's a condition. You can see why. If you buy back shares at above the intrinsic value, you're going to be hurting the remaining shareholders in the company who are staying for the intrinsic value. You're hurting the people you really don't want to hurt. If you're going to hurt a group, hurt the group that's selling their shares back because they're gone. Don't turn your punishment over to the people who are your loyal shareholders who are buying your company because they like your company in the long term. They're buying for that. Yes.
premium, wouldn't the share price also increase? Because more people might start buying it.
Well, initially you might, but you can fool some of the people all of the time, all of the people some of the time. So there might be this temporary bump when you get the buyback, but then there's hangover after saying, what have we done? It never lasts. A bump in the stock price that happened just because if you could just bump up the price by just buying back shares, you know what the end game would be, right? Just keep buying back shares. Your price will go towards infinity because until you get to that one share, it doesn't happen though. Eventually reality kicks in. And what we're doing here is getting a sense of what that underlying reality is. But initially, the banker might say, look, it worked. We pushed the price up to 83.78 or 85 or 87 or whatever they paid. But it's not going to last because ultimately the remaining shareholders have to look at what's left in the company. And now you've essentially made your company a much more indebted company, and you had to factor that in. I mean, it's still good for you, but your share count has not dropped by enough. You will end up then with a lower value per share. It might take a while for the price to adjust to it, but the truth eventually comes out. So the first question of why should we do it? It's a savings you get by going to lower cost of capital. All of that savings is coming from the tax code, but notwithstanding that, there is an increase in value. And if you decide to make this a buyback, that increase in value will show up in that buyback price, driving who benefits more, the people who sell their shares back or the people who stay in the company. What if you're in a market, though, where you're not allowed to do buybacks? Is there a way in which you can execute this strategy in a market like that?
Distribute dividends, but
It'd be a special dividend. Basically, that's the second form you can do this. So the buyback is the more, I think, the cleaner form, but there are fewer markets now than there used to be, but there used to be markets, especially in Europe, where you were not allowed to buy back shares. They had some very strange logic. I can never figure out European logic for anything related to markets, but they had some strange logic for it. But if you're in a market where you can't buy back shares, you'd have to pay a special dividend. You'd call it a special dividend because everybody then would be clear that this was a one-time deal. This wasn't something you could pay every year. So you could pay out 39 point, which would be a huge special dividend, right? It'll be like getting a 20% dividend on your shares, but no stockholder is going to say that's. The problem, though, is it creates tax consequences, and people who don't need the cash, right? They get the cash, they have to pay taxes. That's why buybacks are probably a more tax-efficient way for investors to get cash back. But this is not, it doesn't require buybacks. It just requires that cash be returned to equity investors. So that first question has been resolved. And the board says, okay, we see why the buyback helps. We see how the buyback will be structured. And then one of the board members, one of the more conservative, cautious board members, asks a question that I think you should always ask when you borrow money. What if something goes wrong? And the one answer you should never give, if you're the person pushing for this capital structure, is nothing will go wrong. This is like tempting the gods, because the minute you walk out of the room, then terrible things are going to happen to you. Of course, things can go wrong. Like what? There could be a recession. One of your theme parks might have to shut down. And God help you, there could be a pandemic. But nobody comes to the theme parks anymore. Nobody watches your movies. Of course, things can go wrong. And if you're a prudent business person, you should borrow money and factor in the possibility of something going wrong. So here's what I'm going to do. I'm going to look at a couple of ways I can bring this in. One is I can ask, what if? What if there's a recession? What if something bad happens? And I'll give you very simple mechanisms to feed it through. The second is you can look at the past and say, what happened to Disney's operating income in the last recession, the last downturn? So you can look at both historical data and ask what if questions. There's another way you can build a buffer. When I go to a higher debt ratio, what happens to my bond rating? What should happen? It's going to go down. And I'm factoring in, I'm being realistic, right? There's nothing in this unconstrained approach that would stop me from giving you an optimal debt ratio where your bond rating is BB, right? There's nothing I've built in that says, find the lowest cost of capital. I just find the lowest cost of capital. It's probably not going to happen at a BB rating, but it could, right? But the problem with going to a rating like that is you're flirting with disaster. You're always one shock away. What if I put a constraint on your rating? It's like just one more item that I'm going to add to this. Find me the lowest cost of capital subject to the constraint that your rating is at least single A, at least investment grade. We'll talk about why companies impose these constraints and how some of them have unrealistic constraints. So let's start with the first one. What if something goes wrong? The case of Disney. I have history, enough history that I can look at what happens when things go wrong. So basically, I went back and collected data from 1987 to 2013 of the operating income, saying why the focus on operating income? Because everything in this model is driven by the operating income. It's not driven by revenues. It's not driven by net income. It's EBIT that drives it. And guess what? There have been good years and bad years. The worst year they've had is a 29.47% drop in 2000. That's the worst year Disney's had over this period. The best years, of course, are great. I don't care about the best years because here I'm focused on the downside. During I listed 4 recessions here. I mean, in 3 of those recessions, operating income has dropped by 15, 20, 25%. And in one of the recessions, operating income actually went down. What am I trying to do? I'm trying to look at the company's history to get a sense of what does a bad year look like for this company. I'll give you an example of why this process is useful. If I gave you Con Ed, which is a regulated utility that covers New York, and you looked at the last 25 years of history, you know what a bad year looks like for Con Ed? A 5% drop in operating income. A good year would be a 5% increase in operating income or a 7% increase. In contrast, if I gave you Dell and you looked at the last 20 years, a bad year could be minus 50%. What you're trying to do is get a sense of perspective. What does I know a bad year, your operating income will drop, but how much does it drop? You're saying, so what? Here's what I did. I took the EBIT and I dropped it by 10%, because as I said, that drives everything in the process. It gives you this very simple metric you can focus on because everything bad feeds into your operating income. Whether it's a drop in revenues or increase in costs, it doesn't matter. Ultimately, it's what you're left with is different. And I computed what the optimal would be with that lower operating income. I'm trying to see how much buffer there is in the system. Because remember, I told the company their optimal is 40%. I want to see how much the operating income would have to drop before that suggestion I gave them becomes a wrong one. And I felt pretty good after this what if, because it turns out that operating income would have to drop by more than 30% for my optimal debt ratio in Disney to start decreasing. I'm preparing myself because I know there's going to be somebody conservative saying, what if something goes wrong? And with Disney, my answer is not that nothing will go wrong, but even if you have a bad year, you're going to be okay with a 40% debt ratio because there's enough buffer built in the system. Yes.
How did you compute this?
Basically, it's the same capital structure spreadsheet. Keep everything else the same. Just take the operating income, reduce it by 10%. Right? Because your unlevered beta is still your unlevered beta. That's not changing. And effectively, what that does is feed through into your cost of debt. That's effectively where it shows up. Because at a lower operating income, your interest coverage ratio across the board is going to be much lower at every debt ratio. So in effect, I'm feeding through the effects to see when does it make a difference. Now, will this always be the case? Not necessarily. Let's say you do your optimal for your company. You come up with a 20% optimal. Before you get too excited, if you knock the operating income by 10%, what if the optimal goes to 0% with a 10% drop in operating income? You know what? That should color your conclusions, right? Because then when you go to the company, you shouldn't tell them to go to the 20% because there's not enough buffer built in. This company is too close to the edge for them to borrow money. Go ahead, you had a question.
I have a quick question. So you're doing the buyback by raising debt. What maturity should you get the debt?
That's a different question. It depends on what you're funding with that. It's got nothing to do with the buyback, right?
Yeah.
So if you're borrowing the money here, you're buying back the stock, that debt is now going to be funding your operations, which includes what? Theme parks, movies. So there the question, the second question in financing, what's the right kind of debt is going to come in? So that we will deal with, it is separate from the buyback question. It's a question of what's the right debt for Disney? And the answer will come from looking at their existing assets.
Yeah. Okay, thanks.
So that's the first approach. Here's the second. The rating drives your cost of debt. And in the original analysis, there was no constraint on the rate. It could be whatever you wanted it to be. But the reality is almost every company, every business that borrows money has a rating constraint. They don't want to drop below that rating for lots of different reasons. What's the most common bond rating constraint you see at companies? What's the rating that freaks people out if they drop below it?
Like investment grade.
It's called investment grade, which in actual rating levels is what's the level below which you drop, you fall below investment grade. S&P, Moody's, what's a rating that? It's BBB. If you drop below BBB, you've dropped below investment grade. Why does it freak people out when they drop below investment grade? Because that story shows up in the Wall Street Journal. XYZ company falls below investment grade. And remember the indirect bankruptcy costs we talked about? Suppliers read and say, we got to ask this company to pay in cash. Your employees read and say, let's look for another job. That indirect bankruptcy cost. So that makes complete sense. And you say, look, I don't want to end up putting myself in risk, especially if I'm an aircraft manufacturer. Maybe even a grocery store, you say, I don't care. So investment grade, I understand that. You might even build a little bit of a buffer saying, I don't want to be at BBB, I want to be A- because that gives me a little bit of wiggle room. But once in a while, you will run into a company which has an absolutely unrealistic ratings constraint. We want to be AAA rated or AA plus rating. And then they will say at any cost, rise to the challenge, give them the bill. And here's what I mean by that. When you put a ratings constraint, what are you effectively doing? You're saying, rather than go to my unconstrained optimal, which is 40%, I'm going to stop at 20% because if I go beyond 20%, my rating drops below whatever. When people put in a ratings constraint, you can put two values of company. One at its unconstrained rating. In the case of Disney, that was at 40%. But then I can also value the firm with your constraint put in. Let's say that optimal is 20%. But remember, your cost of capital is going to be higher. There will be a cost. I'm not saying the cost should stop you, but you need to be aware of what that cost is. So let me give you an example. Let's assume that Disney says, in my original 40% optimal, I never drew your attention to it, my synthetic rating is actually single A. So if Disney said we want an investment grade rating, I'm going to say we're already there, so we don't have to worry about it. But let's say Disney comes back and says, we want a AA rating. When I go back and look at my ratings and different debt ratios, it looks like I have to stop at 30% rather than 40%. The value of the firm at 30% is about $5.7 billion lower. So if you really insisted on a AA rating, I can give you the optimal, it's 30%, but I'll also tell you it's going to cost you about $5.7 billion. Now you might weigh it against the indirect bankruptcy costs and say, that's okay. That's a reasonable enough price to pay for how much business we could lose if we are viewed as being in trouble. So what if you have a AAA rating constraint? Turns out that you have to stop at 20%. It'll cost you $12.1 billion. You see why having this bill in front of you can introduce some reality to this discussion? Many companies, if you talk about ratings, a higher rating is always viewed as better than a lower rating, right? It's viewed as an unalloyed good. But that's not true. Every time you put in a rating constraint, you're giving up something. And if you set it too high, you've kind of constrained yourself so much that I have to ask you, why? Why did you have a AAA rating? Yeah.
To make this decision, would you also try to put a number on the indirect bankruptcy costs and weigh them?
That's exactly right. And in a sense, you might ask, what kind of business am I in? Grocery store, you look at the $6 billion and say, that's too much to pay. Aircraft manufacturer, you're a $153 billion company, $6 billion. You say, look, one big contract canceled, $6 billion. So I think that's what
difference.
You got a mic open on Zoom. So it depends on the company. You might not even put a number on it, just get a sense of how big are the indirect bankruptcy costs and try to bring them in. With the enhanced cost of capital, I'm actually going to put a number on it because it does seem a little fuzzy not to bring it in. Now, I'll give you one example of the kinds of reasoning or the lack of reasoning that leads to these unreal rating constraints. long time ago, I was talking to the CEO of a European steel company. At that time, it was perhaps the last AAA rated steel company in the world. So I asked him, what's this fixation you have with the AAA rating? He said, because it lets us borrow money at a really low rate. I said, that's very interesting. But how do you maintain your AAA rating? You know what his answer was? By never borrowing money. This is the kind of illogic that you think about. So basically, you want to be able to borrow money at a really low rate, but the only way you can maintain it is by never borrowing money. Where's the benefit? Sometimes companies have to let go of rating constraints because they just think in terms of interest rates, but you got to think about how much am I able to borrow at that rate? And the effect is actually your company could be worth more as a single A rated company than a double A rated company. And that's something that many CFOs can't get their heads around, because to them, a lower rating is always a bad thing. Which brings me to the third question. In doing all of this, what am I assuming you're going to do with the 39 billion? Either buy back stock or pay dividends, right? Yeah.
Is it just the CFO or the board of directors?
It could be every, I mean, let's face it, if I'd thrown out to you at a company, say, is it better for a company to have a double A or a single A rating at the start of this class? I will wager that almost unanimous agreement that a double A rating is better than, so don't blame just the CFO or the board of directors. I'm just picking on the CFO because that's the decision maker here. This is kind of one of those widely held illusions that a higher rating is always better than a lower rating. If I can keep everything the same and end up with a higher rating, would I take it? Of course I would. But if I have to do a trade-off, a company with a lower rating could be worth more than a company with a higher rating. And it's, I think, a collective illusion that that's not good for you. And that's something that you need to push back against. Which brings me to the third question, right? And doing all of this, I'm doing a recapitalization. I'm borrowing money. And so basically, I'm bringing money in through one window, pushing it out through the other. Which if you're a mature company, you say that makes complete sense. But what if you're a company with growth ambitions? Like Disney wants to build Disney streaming, not in 2013, but today. And I tell them that they have excess debt capacity. It seems kind of silly to borrow money, buy back stock, and then go raise fresh capital for these new projects, right? So the company asks, or the board of directors asks, I think, a reasonable question. You've told us we have excess debt capacity, $40 billion worth. We have these big investment plans. If we use this excess debt capacity to take projects, the project could be theme parks, it could be streaming, it could be more movies. What does that do to the analysis? In other words, does this optimal of 40% still hold if instead of buying back stock, we took projects? It's a tricky question, right? I could give you the easy answer. No, but I'll add a condition, which is as long as you stay with the same mix of businesses you have now. You see why it has to be conditional? Yeah.
Now it's the quality of the projects you get.
It's not so much, the quality obviously matters, but in this case, because it's all about risk, it's going to depend more on, so if they say, look, I'm going to do Disney streaming, should I borrow the money? I'm going to say, be very careful for two reasons. If I ask you to describe the streaming business now, no matter what you think about its potential in terms of risk, high risk or low risk? It's a very high risk business. Technology is shifting. And then if I ask you in terms of cash flows, what kind of cash flows you're going to get on this business, at least upfront? They're going to be big negative cash flows, right? You're acquiring customers, you're making streaming. Think of how much you spend on content. Disney next year is expected to spend almost $30 billion in content, much of it for streaming. So if I'm entering a high risk negative cash flow business, what does it do to my debt capacity? I should be borrowing less, right? Because I don't want to add to my interest payments if I'm taking a riskier. So what I cannot do is give a company a blank check saying you have excess debt capacity, go do whatever you want, because they are going to do whatever they want. They're going to do acquisitions, enter risky businesses. So my answer is, if you want to enter other businesses, take investments, you need to tell me what those investments are. And I will bring in the risk and the cash flows from that investment into the analysis. It's not rocket science. And I'm going to tell you, given that you're entering the streaming business, your optimal just went from 40% down to 30% because your company overall has become riskier and has more negative cash flows. So let's summarize. Why should we do it? It's not the 0.65% drop in the cost of capital that you get. Who cares about that? It's the fact that you can increase your value by 19.6 billion. What if something goes wrong? There's enough buffer built in the system here that even if your operating income drops by 20 or 30%, you'll be okay. And your rating is at single A. What do you have to complain about? So can we take projects with it? Well, if you're building another theme park, making more movies, I'm okay with it. The optimal should, though the company will now get bigger, it'll be 40% of a bigger company. But if you tell me you want to enter a riskier business, a new business, a technology business, streaming business, then I have to revisit the optimal and come back to you with a new optimal. These are three generic questions you always face after capital structure. Go ahead.
So in practical terms, to revisit the calculation of this optimal level with the new business, we would have to go back.
You'd have to change the
unlevered beta.
Exactly. You'd have a new unlevered beta. Your operating income might actually decrease because you're now entering a money-losing business. And once you factor in a higher unlevered beta and a lower operating income, your optimal debt ratio is now going to be much lower than it was before. And that's exactly the process we need to put in place. Because otherwise, they think of it as free money. I'll go do whatever I want with it. And that's not the message you want to send. Yes.
How should we decide for what all projects do we need to do this? Like,
Well, we just finished investment analysis. What's the rule on projects? Positive net present value. So, I mean, that's why so what is the question? The question I asked was, how do we decide which projects to take?
The question was, should we do it for even smaller projects or only after?
But remember, you don't think of the project level financing. Disney on any individual movie might spend, unless it's an Avengers movie, might spend 50, 80 million. You know, the way I think about financing of movies, I think about the portfolio of movies Disney makes. It's not about individual projects, it's about portfolios of projects. So when Disney asks, can we use the money on projects? They're not asking one movie. They're asking, can we fund this doubling of the movie production we're planning with this? So it's a portfolio of investment you're making. And that's what you're asking about, can I borrow the money for it? And the answer is, depends on the risk of that portfolio, the kinds of cash flows it generates. Which brings me to the other companies in my list. So let's do, and I'm not going to take through these companies to the excruciating detail that I took Disney through because it'll kill you if I did that. So think of doing these in the same kind of excruciating detail. So first company I looked at was Tata Motors. Remember, it's a family group company, right? It's one of multiple companies controlled by the Tata family. Their existing debt ratio is about 29% debt. 29% debt, 71% equity. There's my cost of capital breakdown. As I said, I'm going to cut to the chase. I'm going to go to the second to last column. What am I trying to do? Minimize the cost of capital. There it is, 20% optimal. To the extent that I trust the optimal, it looks like Tata Motors has too much debt. But here's where being part of a family group might explain that. I actually did this for Tata Motors, Tata Steel, Tata Chemicals, and Tata Consulting Services. Tata Motors, Tata Steel, and Tata Chemicals were all over-levered. Often they borrowed the money to do acquisitions. Each of those three companies, Tata Steel and Tata Motors in particular, had done big acquisitions that they funded disproportionately with debt. Tata Consulting Services was significantly underlevered, and it's the largest company in the group. At least from my cynical side, here's what I see happen. I think Tata Motors, Tata Steel, and Tata Chemicals are being subsidized by the fact that Tata Consulting Services debt capacity. You see, these are independent companies. How can they be sub? If you're Tata Motors and you walk into an Indian bank to borrow money, the bank is going to look at your financials, and maybe they look at the fact that you're borrowing too much money. So you say, why would they lend the money? Why might they lend the money even though you're borrowing too much money? What is going implicitly through the banker's head?
The other groups within Tata will
that the family is going to make sure that none of these, so in other words, they're going to find a way to move financing or funding across, right? We do this all the time. You know, why do you lend money to this idle layabout? Because his father is really wealthy or his mother is really wealthy, because they'll find this guy's income is not going to pay for the bank loan. But there's a danger here, right? It's an implicit guarantee. There's no contract that says the family group has to come up with the money. And sometimes implicit guarantees can blow up in your face. You look at the United Arab Emirates. Each country, in theory, is its own country. Each part of the United Arab Emirates, Dubai, Abu Dhabi. But there's really one cash cow among this group that feeds all of the others, right? Dubai might be okay, but you look at the rest of the United Arab Emirates, it's Abu Dhabi with the oil and the cash. So it was Dubai ports that went out and borrowed money. And when they were borrowing money, bankers were lending to them at rates that made no sense given the port's own cash flow generating capacity. You know what their thinking was? If Dubai ports gets into trouble, Abu Dhabi will never let them go bankrupt. So bank loans come due. Dubai ports is unable to pay. And the bankers look towards Abu Dhabi, and Abu Dhabi says, look, we don't see our name in the contract anywhere. That default, in a sense, was it's the kind of thing that you need to look at when you make implicit lending. I blame the bankers for doing it, but you can see why they do it. So when you look at family group companies, and some of you doing family group companies, if you find your company to be either significantly under-levered or over-levered, the answer might not lie in the company, it might lie in the family group and how they're financing other companies in the group. Yeah.
Maybe this is not relevant right now, but how would the money move between the two companies? Are we going to cover
You know,
that?
as a family group, you have your ways, right? You know, it would be, you know, you're saying legally, how would you pull it off? The family owns pieces of every company. It's not like they have no pieces. Now, who knows what they will need to do? They might have to sell a piece of their holding in Tata Consulting Services and invest more equity into Tata Motors. That's the you hopefully, you know, from the family's perspective and the bank's perspective, this will never need to come to pass. It's a desperation ploy when it does happens, but they do have some levers in their hand to be able to move money across companies, even if it's just their holding being liquidated and reinvested. Yes.
Why over-lever some of the family businesses and not the consultancy? Aren't they eroding shareholder value by doing that?
If you're the family, how do you think about your wealth? You think about your collective wealth across companies, right? This is the problem when you're a stockholder in a family group company. You're a shareholder in Tata Consulting Services. You should be really pissed off about this, right?
Yeah.
But the family says, we own all these companies, so all we're doing is transferring wealth across companies. It's a classic family group problem, which is cross-company transfer of wealth, which is what's happening here. The family still is okay because they own all of the companies. In fact, they might own a bigger piece of Tata Motors, Tata Steel, and Tata Chemicals. Tata Sons is the family holding company. If they own 15% of those three and only 5% of TCS, you can see their incentives. They're actually better off transferring wealth from TCS to their bigger. So when you look across startup companies or any family group companies, look at the percentage of each company held by the family. It's not a constant percent. Some companies, they might own 50%. Some might they own 100%. Some, there is this problem. And this is why whenever you invest in a family group company, you're making a joint bet on the company as well as the family. Okay? Because if the family really wants to rip you off, then you're pretty much dead in the water, right? Because they can find legal ways in which they can transfer wealth, especially if you have intra-company transactions. Think of how easy it is to make one company have more profits and the other have less profits.
So why don't activist investors just go in and
what are you going to do?
corporate rape and like carve out, say, Tata Consultancy?
How would you do it? Remember when we did corporate governance? What is the structure that the Tata companies used to keep outsiders out? By putting all the cross holdings, they collectively end up with enough of a critical mass that it becomes almost impossible for an activist investor to come in and get that percentage. So this is why corporate governance is always in the background. You say, why don't we do that? The answer often lies in that very first part. Where does the power lie? The second company I looked at was Vale. Their actual debt ratio, I think, was, they were at, I don't know, 30-something%. If you look at their optimal debt ratio at the time that I did this, it was at 30%. So again, I'm doing the same process. Vale looks over levered. In fact, the CFO of Vale actually took this class. I don't know whether he's still the CFO, maybe he's been fired since. But he took this class like 20 years ago. So I emailed the guy and I said, I was looking at your company at Vale, and I noticed that you look like you have too much debt. And he gave the standard commodity company CFO's answer. He said, iron ore prices are down. That's why it looks like we have too much debt, but fill in the rest of the story. But prices move in cycles. So iron ore prices will go back up and we'll be okay. And there is relevance, right? Because if I took any oil company in 2000, right? I'm sorry, 2020, after oil prices dropped, and I looked at the optimal debt ratio for every oil company, what would I find? Every one of them looks over levered, right? Today, if I take those same oil companies and I look, they all look under levered. And neither answer is really right because you got to borrow across the cycle. Fair enough. And here's how I brought that in. I looked at what the average operating income would be, and I computed the optimal based on it. And in fact, you might say go back longer. So we can debate how long is the cycle, and I can look at, but when you look at commodity companies, and some of you are, last year's operating income might be misleading. It might give you too high or too low and optimal because operating income is changing over time. So we have cyclical companies or commodity companies, rather than use last year's EBIT to drive your optimal. And EBIT is really the key variable here. Think about how that number moves across the cycle and use some kind of normalized number, because you want to borrow money to cover a normal year, not a really good year or a really bad year. Yes.
Would the same kind of analysis be true for businesses like retail, where you have seasonality within?
Anytime you have a worry about was last year's income too high or too low, seasonality is not an issue, right? Because seasonality plays out across. I'm not borrowing based on a fourth quarter income, I'm basing it on a year. So seasonality will take care of itself, but cyclicality will not. So you're a retail company that's cyclical. If I take you in a recession year, it always looks like you're over levered. Which brings me to Baidu. If you remember, Baidu's actual debt ratio looked really low. It was, I think, 5.23%. And your first reaction when you look at a debt ratio that low is, hey, they should borrow more money. So I decided to see what the optimal debt ratio for Baidu is. And if you look in that second last column again, my optimal debt ratio is about 10%. My conclusion for, remember when I say it's 10%, because I'm moving in 10% increments, all I'm saying it's around 10%. It could be 6, it could be 7, it could even be 5.23%. Why is Baidu's optimal debt ratio so low? Why is Disney's, you see optimals, in fact, in the 4 companies, I went 40, 20, 30, 10. Could your optimal debt ratio be 0%? Absolutely. For a high growth company, going to a 10% debt ratio, even though they're making money, going to a 10% debt ratio could push you over the edge, because 10% of a really huge number, Zoom or Peloton, right? Peloton might be making money. But remember, if I'd gone in last year, looked at the market cap and taken 10% of that, the amount of debt that I would take to get to 10% would essentially tip me into bankruptcy. Don't let the percentages drive your thinking, because a percentage of a very big number can be a lot of debt. You know what 10% of Apple's, Apple has debt ratio only 10%. You're saying only 10%? It's actually less than 10%, but it's 150 billion in debt. Why is it only that small? Because your market cap is $2.5 trillion or $2.6 trillion. So with Baidu, the optimal debt ratio is low because their value is high, reflecting their growth potential. And they really shouldn't be borrowing money. Many of you are valuing younger companies or growth companies. Don't be surprised to get low optimal debt ratios for companies even as large as Amazon, because Amazon is a huge company in terms of market cap, but not that big in terms of operating income. Finally, I took Bookscape. Now, you're saying that's a private bookstore. It doesn't matter. Private businesses have optimal debt ratios too. They can borrow too much or too little. And here I ran into a little bit of a estimation problem. Remember when I started the Disney analysis, the number that drove everything was their existing enterprise value. Remember the 133.9 billion? And I got to it by taking market cap of equity plus debt, which for a publicly traded company is not a big deal. They're all out there. My first big problem with Bookscape is I don't have a market value of equity. I don't even have a starting number. So I cheated. And what do I mean by cheated? Well, this is no market cap. I had to estimate what the market cap might be. And by cheating, all I did was I took the net income for the company and multiplied by the average PE ratio for book retailers. Very back of the envelope. But what's the alternative to doing this? Using the book equity. And that thought terrifies me. I'm not even going there. I'd much rather have a bad estimate of market value than a good estimate of book value. So market value of equity gives me 31.5 million. Once I have that, the rest of the process looks very much like Disney. I add the two numbers up. I come up with an estimated value for the company. I come up with an optimal debt ratio. And the optimal debt ratio I have for Bookscape was about 30%. They were actually at 27.81% with their lease commitments. Again, that difference basically means they're close enough to optimal that I'm going to say they're at their optimal. So with every one of these companies, I'm essentially focusing on what they can afford to borrow, given their operating income, given their unlevered rate. It's the same process playing out again. Now, just as an aside, this was in 2013. I've been doing this every year. And for most of the years that I've been doing this, because I've been doing this in the 1990s, the tax rate for the US was about 40%. Because remember, the tax benefit of debt is based on the marginal tax rate. And in 2017, that tax rate was lowered to 21%. And we talked about what this should mean, right? Holding all else constant. If I can take that spreadsheet and I take my 40% tax rate and lower it to 21%, my optimal debt ratio will always decrease. So the question is, how does that play out? In addition to lowering the marginal tax rate, the 2017 tax law also introduced a limit on interest tax deductions. It said, look, if interest expenses exceed 30% of EBITDA, and it's kind of fuzzy on the definition of EBIT, but there's a certain amount that, so you still have EBIT, but if it exceeds that amount, you start to lose tax benefits. So both changes should reduce your optimal, right? The first by directly affecting the marginal tax rate, the second by affecting your potential tax benefits, especially at higher debt ratios. So I actually took Disney in 2018 and I computed what would happen to their optimal under the old tax law and under the new tax law. So I brought in both facets of the new tax law, the lower marginal tax rate and the limit on interest expenses. In fact, that limit is now built into your spreadsheet. Many of you don't even trigger that limit, but if you hit that interest expense exceeding, 2,000 and EBITDA, 30% of EBITDA, I start taking away tax benefits. So here's what the optimal looks like. So the optimal debt ratio I had for Disney with the pre-tax code change was 50%. The optimal I got for Disney post-tax code change was also 50%. We're saying that's weird. But here's where you notice the difference. Notice that at every debt ratio now, my value of the company with the higher debt ratio is lower than it was before because I'm giving up a 19% or 18% difference in marginal tax rates. And also notice how once you get to about 20% debt, the value of the firm pretty much levels. It's increasing, but it's increasing much less than it used to. Let me ask you a question. If your value of the firm at 20% is 50 billion, and increasing a debt ratio to 50% makes it 52 billion, my advice to you is don't go to 50%. There's not enough upside here for you to risk the company. If nothing else, you can see why the change in the tax code should make you less likely to borrow money. See what happens at 50, when you get from 50 to 60. All of your cost of capital analyses, there's what I call a cliff. In other words, your cost of capital moves smoothly until the cliff. And then once you hit the cliff, you just collapse as a company. What happens? Your ratings go into this tailspin. Remember the interest coverage ratio? You go into the spin where your rating drops, your interest expense climbs, your rating drops again. So before you know it, your rating will go from single A to single B over the course of a 10% or a 20% change in debt ratio. And that's in a sense reality, which is if you get really close to a debt ratio that could put you in danger, one little tip and you're over the cliff. My advice to companies would be don't go near the cliff. So even in the pre-tax code world, I'd probably advise this need to be at 30 or 40% debt, not at 50, because even though technically that's the optimal, it's too close to the cliff for them to risk being there. Again, something that might color. So what I'm saying is don't take the optimal debt ratio and just feed it as, because if that's the answer, why would I need you? I would just say, take the spreadsheet, put it to companies, every company would have its optimal. This is where understanding the company and understanding the cliff is going to color your conclusions. Yeah.
Why is the cost of capital shooting up at that cliff?
Well, because same reason, right? If your ratings drop and your cost of debt soars, because by then you're 60% debt, you're going to see a big surge in your cost of capital. The trade-off is starting to blow up in your face.
The cost of debt is driving that.
Exactly. Because at 60%, it's 60% debt, right? It's you're getting to be a company that's mostly debt. So any changes in your cost of debt have a huge impact on your cost of capital. So one things I've been tracking since 2017 is whether companies in the US at least are using less debt. That's what you'd expect given the tax code. If the change is happening, it's incredibly gradual. So what you see here is total debt with leases, because I've always considered leases as debt. And in fact, 2017, 2018, they looked about the same. 2019, the debt increased. But as a percentage of the overall firm value, that number has been slipping down, partly because stock prices have been going up. 2020 was a strange year. You couldn't really do much with that year because of COVID. 2021, it's kind of dropped, the debt has dropped again. But one or two things is happening. One is companies are adjusting really slowly to the tax code change, or they're just on inertia. They're on autopilot. They're not even thinking about the tax code when they borrow money, and that wouldn't surprise me in the least. Because what's the rationale for borrowing money? It's cheaper than equity. It's still amazing how many companies still fall into that trap. And it's fed into by another illusion, which is if interest rates are lower, debt gets even cheaper, right? We talked about why that's not true, but because people keep these costs of equity at arbitrary numbers, and the cost of debt is the only thing that's sensitive to interest rates, as interest rates go down, they start to borrow money thinking it's cheaper. Neither is a good reason for borrowing money, but you can see why debt stays where it is. Now, this approach that I just described is a very simple approach. It takes something we use in corporate finance all the time and use it to come up with the optimal. But it's time for us to look at its dark side. First is, it is static. You know what I mean by static? It takes one set of numbers, last year's operating income, interest rates today. In other words, you're running the spreadsheet based on a set of numbers. And we know the world is dynamic, things can change. Second, it ignores indirect bankruptcy costs. We did it subjectively by letting people put a rating constraint, but we really didn't bring it into the analysis. And third, it does make these assumptions about betas and ratings that might be questionable. With betas, what does the levered beta equation assume? That all of the market risk in a company is borne by the equity investors, right? That's true if you're a single A, double A, triple A rated company. But if you're a single B rated company or a triple C rated company, guess what your bonds behave like? They behave more like stocks than bonds. In other words, those bondholders are now bearing some of the market risk. So the levered beta calculation might be off. It's not a big deal, but at very high debt ratios, you might be overstating the levered beta and the cost of equity for these companies because you're loading up all the market risk. And on the ratings, I did use the interest coverage ratio, kind of this simplistic. So you can pick at the cost of capital and say, that. So I've wrestled with how to bring these in. Okay? And I've come up with this approach that I call the enhanced cost of capital approach. And I'll describe what I do. The first is I assume that if there are indirect bankruptcy costs, they show up in your operating income. People stop buying your product, you have higher costs, your operating income is going to go down. So here's what I'm going to do. Rather than leave the operating income at that fixed number, remember it was 10 point something billion for Disney and I left it at that number, whether your rating was AAA or double C, I'm actually going to make your operating income a function of your ratings. As your ratings drop, especially as they drop below investment grade, I'm going to knock off operating income, saying that's going to hurt you. The second, if I wanted to make this dynamic, remember that Monte Carlo simulation we did when we did investment analysis? I could do something similar here where rather than leave the operating income as a single number, I make it a distribution. Think of the power it'll give you with a commodity company or cyclical company then to bring it into the analysis. Yeah.
Just a quick clarifying question. That case that we saw earlier.
Yeah.
Is different than the line for the investment grade. So the operating income will, I guess, will start shifting around the.
Okay, so let me show you a table. This is for instance, what's built into the spreadsheet is I built in 3 different choices. Why 3? Because I had to keep it kind of within control. I said for your company, is the indirect bankruptcy cost low, medium, or high? So if you're a Boeing, you put in high. If you're a grocery store, you put in low. For every company, lower ratings potentially could open the door, but the effect is going to be different. So let's take a company with low indirect bankruptcy costs. You go to single A, not a big deal. I don't affect your operating income. A minus. Now, triple B, you're close enough now that there's going to be some effect. 5% drop. Double B plus, it becomes 10%. So basically what this will then become is as your ratings changes, I go in and adjust your operating. Your numerator is also changing in addition to your cost of capital. So when you think about valuation. You're saying, where did I come up with these numbers? I actually looked at companies that get downgraded and I looked at their operating income in the following year. There are companies that get downgraded through time. And essentially, I looked at the operating income the following year to see what it did. That's the best I could do. But now, when you change your debt ratio, I'm bringing in the effect into your operating income as well. Yes?
So in this case, we should be considering EBITDA, not this.
You could, but if you drop one by 1%, the other is going to drop. The die is not moving, right? I mean, rule in finance is focus on what moves, not on what doesn't move. So in this case, the DAO is not affected by whether you have a triple base single. So why even focus on the number that doesn't move? Focus on the number that does. So here's how Disney looks if I bring in indirect bankruptcy costs. So think of the difference between this spreadsheet and the one you saw before. In the previous one, what did I do? I went to the lowest cost of capital. Here I can't do that because what if at the lowest cost of capital, my operating income drops by enough that I actually end up as a less valuable company? So this requires a little more work because I've got to factor in both the lower cost of capital as well as the lower operating income I'm going to have at a higher debt ratio. It's a net effect that's going to drive that. So what you see in the last column is my estimated value for Disney as a company at different debt ratios. Your objective is to maximize value. In the previous case, maximizing value and minimizing cost of capital converged. But in this case, maximizing value would make you stop at 30%, even though you could lower your cost of capital more by going to 40%, because what you lose in terms of operating income overwhelms whatever you can gain by having a lower cost of capital. In general, putting in this, so this is an option in the spreadsheet. You can ignore it and say, look, I don't want to build an, if you say you want to build an indirect bankruptcy cost, and you say, yes, that's what I'm going to be doing in the background is computing your value of the firm. So don't be surprised when your optimal comes in at a value that is different from the debt ratio at which your cost of capital is minimized. Any questions? Yes.
Here it is the same, right? With 40%?
Yes, it is. I'm sorry, it is 40%. But now the tipping point becomes worse. So if you compare the two, so did I say 30%? So it's 40% both, but the tipping point, if you compare the two graphs, once you get to 40% and you look at what happens, because you have the operating income effect, the dropping off the cliff becomes even steeper. Now, there's one company I've completely ignored in my analysis, right? We've done Disney, we've done Tata Motors, we've done Baidu, we've done Bookscape, we've done Vale. You're saying, what about Deutsche? What's your optimal debt ratio for Deutsche? God only knows. And here's why. We don't even know what debt is for a bank. How the heck are we going to determine whether a bank has too much debt? But we do know whether a bank has too little equity, right? Because if a bank, there is a certain amount of equity, So rather than think about how much debt should Deutsche have, what if I reframe the question of asking, does Deutsche have enough equity? So here's what I'm going to do. Rather than minimize the cost of capital, which is almost meaningless for a bank, I'm going to focus on regulatory capital. I'm going to ask, does this company have enough regulatory capital, which is very close asking, does it have enough book equity? If it doesn't, we have a problem. You have to go out and raise fresh equity. You don't pay down debt. You actually have to go out and raise fresh equity. It becomes entirely about the regulatory capital. So I'll give you a very simplistic example first before we look at Deutsche. Let's say you have a bank. It's got 100 million in loans outstanding. So it's a traditional bank. It takes deposits, lends it out, makes money on the spread. It's got 100 million loans and it's a book equity of 6 million. Let's for the moment assume that book equity and regulatory capital are the same. They're not always the same, but let's say they're the same. Right now, its regulatory capital ratio is 6%. This is a growing bank. Next year, it expects its loans to go up by 50 million to 150 million. But it also wants to become more conservative in its regulatory capital ratio. So the bank CEO says, look, we're growing, but we also want to raise our regulatory capital ratio to 7%. So right now they're at 6 million. And if the plan comes through, they will need to be at 10.5 million, 7% of 150 million. So if you think about mapping out what this bank has to do, it's right now at 6 million. By the end of next year, its book equity has to become 10.5 million. Now tell me all the different ways you can raise book equity at a bank. What's the easiest and most painless way? Well, I mean, the deposits ultimately pay out because you can't take deposits and put them into book equity. It is retained earnings, right? So first stop is, how much net income am I going to make? If you make 5 million in net income, I have a very easy path for you. What do you need to do? Pay out a dividend of only 10%. The remaining 4.5 million will then go in. Your retained earnings. So now do you see how I'm going to do dividend policy for a bank? Is basically, I can take the net income, and if you have enough net income, tell you how much you can afford to pay in dividends. But let's say that's not enough at this bank. They're existing, so they need to come up with 4.5 million, but they have only 2 million in net income next year. So the most they can retain is 2 million. I might not be able to tell the bank that it has too much debt, but I can tell it has too little equity. I can tell the bank, you got to raise 2.5 million in new equity next year. Whether you make a rights issue, new stock, whatever it is. When you think about financing at a bank, that's the way we think about it. That's why regulatory capital becomes this fulcrum for a bank. And if you try to think about this for a regular bank, things get really messy. So for instance, for Deutsche, their Tier 1 capital ratio was 15.13% when I did this. Let's say the bank tells you, and many banks have targets, they say we want to be at 18% in 5 years. Why? Because there's all this regulatory pressure on us. We want to build up more buffer. You can take that Tier 1 capital ratio, and because it's calculated on the base of assets, which includes loans and other businesses they have, I can compute how much Tier 1 capital you will need for the next 5 years. And then once I have that, I can then say, look, here's your net income. Here's how much you need as regulatory capital. And hey, guys, first, if we ask them how much can we pay in dividends, what's my advice going to be for Deutsche? Don't. You don't have the net. You have the net income, but you need the capital. You'll actually have to raise 4 billion, and this was in a good year for Deutsche. You should have seen what Deutsche looked like in 2016. But in 2013, in a good year, my advice to Deutsche is stop paying dividends. It doesn't make sense. And guess what? This would have been advice I would have meted out to probably 75% of banks in 2009. Because the 2008 shock took away so much of the capital. But here's where the insanity of being a bank comes in. These banks continued to pay dividends even though the regulatory capital was in the ditch. And so it's almost strange. They paid out dividends through one window and issued new equity on the other, which makes absolutely no sense to me. Because this isn't a temporary problem. This is a long-term problem you have. And you need, at least for the moment, stop digging if you're in a hole. So when you think about financial service companies, luckily none of you is doing it, you will need at least a passing acquaintance of regulatory capital to understand whether this company is undercapitalized or overcapitalized, but everything is about equity. It's not about it. So if you're a bank, think about the different strategies you can adopt. The first is you can take the regulatory capital and view it as that's what you're targeting. That's the minimum. I'm just going to go for the minimum. The danger there is you're one shock away from it. The second is to self-regulate. Remember there were banks before the Basel Accords? Like the Rothschilds have had banks in Europe going back 600 years. Did they have regulatory capital? Absolutely, it was self-imposed, which is they said, hey, we're loaning out money. We need to have enough capital to cover a shock. Good banks have always had self-regulatory capital, which means there could be an external capital ratio, but your self-regulation might lead you to a very different number because of what you view as. Ultimately, you know, that this is not about fooling the bank regulators. It's about survival as a bank. And finally, there's some combination, and most banks now run a combination strategy. There's a tier one. You can't ignore the regulatory minimum, but then you impose your own. So if you're a conservative bank, you might build a big buffer on it. Why? Because you want to survive that next big trading loss you're going to have, or that loan that gets written off. So if you're a financial service company, it all becomes about equity and making sure you have enough equity. Yes.
Is this where like self-regulation and regulatory capital, is this where advanced RWA and standardized RWA come into place?
I'm sorry, what do?
Is this where advanced RWA and standardized RWA come into place?
What can you, what are,
Assets that you use?
I don't even know what advanced and standardized would be. So no, I'm sorry. So if you can describe them to me, I could probably respond better. So what's a different?
I don't know. I think in, like when I've read the financial services report, they have two risk-weighted assets.
Oh, I see. Okay.
And one is advanced, but I just thought that probably to calculate self-regulation.
I'll tell you what drives this process of kilter is when the regulators write rules, they write it based on the risk level of the assets. And the risk level of the assets obviously based on the outside looking in and saying these are very risky, these are safe. But within the bank, you actually know that some of the things that they think are low risk are actually much higher risk. Right? So if you're a good bank, you should be self-regulating, even though the regulators don't see the risk, you should be bringing in capital. So I don't know the meaning of those words, but if I were looking at a bank and they said, look, this is our tier one capital ratio based on the regulators, and then I'd ask them, is that enough? They should have an answer based on what they know about their own assets. So let's look at all the different companies. We come up with different optimals and ask the question, why are the optimals different for these companies? So I asked some what if questions. First, I said the big driver of the optimal is the tax rate, right? I use 40%, 34%, 30%, depending on the company. So I took each of my companies, kept everything else constant and lowered or changed the tax rate. And guess what I find? For every one of these companies with zero taxes, the optimal is zero. There is no escape hatch here. If I make the tax rate zero, there is no company where the cost of capital is going to decrease at a higher debt ratio because I get all the bad stuff, the bankruptcy costs and all and none of the good stuff. So that doesn't surprise me. And with every company, as my tax rate goes up, my optimal goes up, but it goes up in fits and leaps. It's not like this continuous variable. So that's pretty simple. Higher the tax rate, the greater the tax benefit. Second, I looked at the cash flows because remember, ultimately, you don't pay debt with market cap, you don't pay debt with potential, you pay it with operating income and cash flows today. And I used a very simplistic measure of cash flow where I looked at the EBITDA as a percentage of enterprise value. Remember, the enterprise value is the market number, the EBITDA. And here's my hypothesis. The higher the EBITDA you have as a percent of enterprise value, the more you should afford to borrow. Why? Because you have cash flows, you can service a lot more debt. And roughly speaking, that turns out to be the case as well. But there are other factors that come in. Depends on the country you're in, how stable or unstable the EBITDA is. So when you look at a company, and what I'm giving you is a framework, because when you look at your 5 or 6 companies in your group and you look many and you see differences in debt ratios, first thing you're going to check is tax rate. If you're an Irish company in your mix, of course, it's going to have a lower optimum. Second thing you're going to check is cash flow potential. You know what that number is going to look like for high growth companies? If I do EBITDA divided by enterprise value for Amazon, I get like 3%. Why? Because the enterprise value is so large relative to the EBITDA. That already tells me that when I do the optimal debt ratio for Amazon, I'm not going to get a 50%. I'm going to get a 3 or a 5%. In contrast, if I take ExxonMobil and I take their EBITDA last year and divide by enterprise value, I get like 18%. I don't even have to plug the numbers in to tell you that your optimal debt ratio for any oil company is going to come in sky high because the enterprise value is depressed now relative to the EBITDA. The third factor is risk. Obviously, riskier companies should borrow less than safer companies. Where does it show up in your analysis? In 2 places. One is that unlevered beta that you have for your company reflects its underlying business risk. That has a multiplier effect on it. So if I put in an unlevered beta of 3 for a company, I should be surprised to get a much lower optimal debt ratio than if I put in 0.7. And on the debt side, it should show up better, but because of the way I'm doing it, it doesn't show up fully because I'm using an interest coverage ratio for your company, right? The only discriminatory power I give you is small companies versus big companies. If I truly wanted to make it richer, I should be breaking down companies by how unstable your operating income is, and perhaps give you a choice of 5 different groups based on whether you have very predictable operating income at one end or very unstable operating income at the other. I'm leaving that in your hands when you ask the what if questions. That's why the what if question becomes so critical, because if you have a company where operating income doesn't change much, I'm saying worry less about this instability. And there's one final factor that drives the optimum debt ratios. As a company, you can either raise equity or you can borrow money, right? There are 2 markets. They both build off the risk-free rate, same risk-free rate. But when you borrow money, what do you add to it? You add a default spread. When you raise equity, you pay an equity risk premium. Those are set by the market, and those numbers move through time. Most of the time, they move together. When one goes up, the other goes up, because people freak out in one market, they're freaking out in the other. But there have been periods where they moved in opposite directions. The 1990s, for instance, the equity risk premium kept coming down. The default spreads didn't even just stay stable, it actually went up a little bit. In 1999, if you were a CFO at a company that says, should I use equity or should I use debt? Equity is now really cheap because not because the risk-free rate is different, but because the risk premium is low. The equity, you would be issuing equity till it was going out of town, right? Basically, that's what companies did. They went out and raised equity. Equity had become too cheap relative to debt. Then you look at the first half of the next decade, the opposite effect kicked in. Default spreads actually stayed low, but equity risk premiums went up. So in 2005, you're a company, and I said, do you want to borrow money or raise equity? Holding all else constant, you were going to find that debt was much more attractive. It's a golden age of leverage buyouts. Those prices for risk that we talked about earlier become part of the inputs in your cost of capital, right? I'd ask you what your equity risk premium is. If you want to try something different, make your equity risk premium 9%, leaving the default spread where it is. You know what you're going to find? Your company borrows a lot more money. If you make your equity risk premium 3% instead of 5%, whatever you started with, you're going to find that your company uses a lot more equity. So that's the only macro variable I think about. But I'd like you to try the capital structure spreadsheet. I sent you a link last time, but I'll send it again after the class today. Plug in your numbers. It's a 10-minute job. I don't know whether you've ever read this story called The Little Red Hen. No, go to Amazon, buy the book. Actually, you don't have to buy the book. It's about a red hen that does all this work during the winter, during the summer, getting food ready. And there's this grasshopper and all these other creatures that are doing whatever they want, dancing. And then winter comes and the red hen is ready. And then the others don't have food. They come to the red hen and very cruelly she says, I did all the work and I'm going to eat. You're not, you're going to starve to death. You say, what's this got to do? A lot of you haven't even been working on your projects. Some of you are already doing everything. You're like the little red hen. You got the cost of capital nailed down. But I'm going to violate the moral of that story. When you do this capital structure spreadsheet, it'll magically get you caught up because it capitalized leases, it can compute your current cost of capital. So you'll get caught up with the people who've been working all the way through here. So it's like a bonus. And then you can move on from here. You say, I'm caught up now. So try the spreadsheet to give you a chance to get caught up in the project. And I will see you on Monday.
Yeah, I mean, he has a brief section with a ton of resources.
Yes.
Yeah.